Investing in the stock market can be a great way to grow your wealth over time and secure your financial future. But with so many options out there, it can be a little bit overwhelming to figure out where to start. That's why I created Get Irked in 2018, to teach others how to invest and to do it for free so that you wouldn't have to waste money buying some scammer's course. First, let's talk about what exactly stocks are. When you buy a stock, you're essentially buying a small percentage of ownership in that company. As a shareholder, you're entitled to part of that company's profits, which the company will either choose to pay out in dividends or put back into the stock, which will cause the stock price to increase over time, called a capital gain. Stock prices go up and down on a variety of different factors, including the company's performance, global macroeconomic concerns, political concerns, and so much more. That's why it's important for you to do your research and choose your stocks carefully in advance. The first step is finding the stock of a company that you want to invest in. Typically, I start by picking a sector that I'm interested in. If I'm not interested in the sector itself, then I'm not going to keep up with it, and I could make a big mistake picking the wrong company. After I pick the sector, I drill down to find the best in breed. A best in breed company is simply the best one in the sector. Now, it can be tempting to pick the underdog, thinking that it's going to outperform and eventually beat the leader, but this isn't a Disney movie. There's no guarantee the underdog will ever perform that well. So you should always go with the best in breed. In retail, you'd want Costco. In athletic apparel, you'd want Nike. In artificial intelligence, NVIDIA. In electric vehicles, Tesla. And so on. When in doubt, always stick with the best in breed. As for research, there are many different methods you can use to learn more about your stocks. There's fundamental analysis, which means looking at the company's growth over time, its price to earnings ratio, its debt balance sheet, and other factors affecting its finances. There's also technical analysis, which means looking at the stock on a chart and looking at its price action over time to determine where to buy or sell it. There are many investors who just choose to stick to one camp, either choosing the fundamentals or the technicals. But I find it works a lot better if you use a blend of both. I know I'm not smarter than a chief financial officer, so I don't spend a lot of time looking at a company's balance sheet. What I want to know more is, how does the management team perform over time? If you're taking a company like Nike, it's important to see that it does suffer tough times in the past, but it always recovers. Additionally, in the 11 years that I've held my Nike position, it's had several different CEOs, and every CEO performs as well or better than the past CEO. So you don't have to worry about the leadership on the top. If you're looking at a company like Tesla, where Elon Musk is the innovator behind the company, it would be a really awful scenario if Elon Musk suddenly died. So you need to take that kind of a scenario into consideration when you're thinking about Tesla, where that's not as critical when you're talking about Nike. One important element that all investors should keep in mind when building a portfolio is something called diversification. This means you spread your investments across different stocks and different assets that are in different sectors in order to protect against single company or single sector risk. This means that if one investment does poorly, as long as your other investments aren't in that same sector, it's possible that they will help offset any of the losses you'd see in that one investment. By having a broad swath of different investments, you'll help ensure that you're not going to get a hit as hard as if you were all in on one sector or one asset class. When building your portfolio, not only do you want to pick stocks from different sectors, you should also consider spreading it out across different asset classes, like stocks, Bitcoin, gold, real estate, and more. Not only should you diversify by asset class and industry, you shouldn't limit yourself to one country or region. By investing in a variety of geographical regions, you're further spreading out your diversification and protecting your portfolio. If you missed the incredible rally that we saw in 2023, you might be feeling FOMO right now, or fear of missing out, and you might want to get in quickly before the end of the year. This is a mistake. Historically, whenever the stock market sees an epic rally going into the end of the year, it will pull back 5 to 20% or more in the next year. In fact, in many cases such as 2018, this pullback actually happened in January. In 2018, the S&P 500 pulled back 11.84% from its high in December of 2017 to the low at the beginning of February 2018. A more than 10% pullback in a month. This was an excellent buying opportunity for patient investors. But for anyone who rushed into the market at the end of 2017, this pullback was painful and could have caused them to make a mistake like selling near the lows. Let me go over two different strategies that makes putting money to work easier. The simplest strategy is what's called dollar cost averaging, or DCA'ing. Instead of trying to time the markets, investors pick a day of the week where they're going to put more money to work. And every time that day comes up, they put more money into their investments, regardless of whether the stock market is up or down on that day. For the more passive investor, DCA'ing actually removes emotions from investing because you're always going to invest on that day, regardless of what the market's doing. For new investors in particular, seeing the market rally or crash can cause you to make a mistake by either buying too much or not buying at all because you're following your emotions. Removing those emotions is particularly critical. Remember that you're in this for the long term. If you're like me, you have a time horizon of more than 20 years. DCA your buys and ignore those short-term market gyrations. And remember, for us, a short-term gyration can last weeks or even months. It is absolutely vital to develop a long-term investing mindset. You're talking about years, not days. Don't get wrapped up in short-term movements. If you're willing to put in a little extra effort and do some research in advance, the strategy that I've used that's worked for me for more than 2 decades is called buying in stages. Instead of buying on a certain day of the week, you're buying at a certain pullback in the investment. This requires that you pick quality investments in advance. These are investments that you trust will succeed in the long term. Many investors will tell themselves that they would be totally comfortable buying a stock or an ETF if it sold off 20%. Because when you're out of the moment, that feels like an epic sale. However, when sell-offs happen, they often feel like this time is different. This time is the end of the world. And these investors who claim they would buy at those discounts stay on the sidelines because they're too scared to put money to work. There are 2 ways you can buy in stages. First, you can buy in percentages. Let's say you were buying VTI, Vanguard's Total Stock Market Index ETF. You could put money to work in VTI every time it pulls back 2.5%, adding a little bit more whenever it makes another 2.5% increment pullback. You would make your first buy whenever VTI pulled back 2.5% from its most recent high. Then 5%, 7.5%, 10%, and so on. I don't get too complicated with this. I'm using technical analysis to find levels of support and resistance. Basically, this is just looking at a stock's chart. And you can do this with a free service like Google Finance, Yahoo Finance, or TradingView. When you get started, you don't want to be on any time frame that's shorter than the weekly view. We're long-term investors, and we're looking at keeping these investments for 20 years or longer. So I use the weekly or the monthly view. Personally, I prefer the weekly view because it gives me more price action for what I'm about to do. When you look at a chart, each bar referred to as a candle represents a week's worth of price action. The upper wick represents the high of that week, and the lower wick represents the low of that week. If you look in the past, you can see that the investment, in this case VTI, has a lot of price action around a consistent price point, with wicks pulling through that price point over time. This price level is called support, and it's one of my buying targets, but it won't be my last one. I never buy all at once because sometimes the investment won't hold that level of support and will pull below it to another level of support. In order to make a buying plan, after I make my first buying target, I'll move lower and do the same process over again, repeating all the steps and finding the next level of support, which will be my next buying target. I repeat this process over and over again, buying a little bit more as the investment sells off, because the more it sells off, the more likely it will become to find levels of support that will hold. In order to avoid having emotions affect me, I will actually put my limit orders for my investments in advance with my broker. I calculate how much a 2.5% pullback in VTI is, enter that in as a limit order with the quantity I want to buy, then 5%, 7.5%, and I increase the quantities that I buy the further VTI pulls back. In addition to removing emotions, this strategy capitalizes on what's called flash crashes. Flash crashes are when an event in the stock market happens so quickly that the market sells off and recovers within the same day. and sometimes recovers in a matter of minutes. By using limit orders that you place in advance, your account will automatically make those buys as the asset sells off, even if you don't have the time to access your broker before the flash crash is over. Want to learn more? Check out all the videos that I have on my channel. Follow me on X at Get Irked. Visit my website, getirked.com, or my Substack, getirked.substack.com. If you liked my video, please hit like and subscribe. It really does help the channel out. Thank you for watching, and I'll see you in the next video.